The financial world has just endured a manufactured cataclysm. What you witnessed last week was not a natural market correction. It was a high-stakes financial theater. A calculated demolition designed to flush out the weak, reset expectations, and test the very foundations of value. The star of this drama was silver, a metal whose dual nature as both a monetary relic and an industrial cornerstone was violently torn asunder. The paper price, a speculative phantom living in servers and leveraged contracts, was bludgeoned down 13% in a single day, culminating in a 28% weekly collapse, its worst performance in over 40 years. The trigger was a seemingly unstoppable force, an economic report of shocking strength, a hawkish central bank pivot, and the cold, mechanical rules of the exchange itself. Yet from the heart of this engineered chaos, a profound and unshakable truth has emerged. This is the story of that great decoupling. The moment the tangible world of atoms began its final, decisive divorce from the fragile world of digits. The first act of this drama was an economic earthquake. The February non-farm payrolls report wasn't just a beat, it was a revelation. 89,000 new jobs materialized against a forecast of 50,000. Unemployment fell. Most critically, the manufacturing sector, the very heart of industrial metal, demanded 28,000 positions. This resilience is monumental. It's happening while trade policies have severed traditional supply chains, signaling a historic reshoring of critical production back to American soil. The immediate market interpretation was pure. Orthodox finance, strength begets hawkishness. The US dollar index ripped 2.8% higher. Bond yields spiked. The probability of a March interest rate hike under the incoming Fed chair, Kevin Warsh, locked in at over 80%. In the old textbook, this environment is a burial ground for precious metals. Gold, lacking an industrial narrative, obediently sold off. But for silver, the story was about to take a radical, system-breaking turn. For the second act, the architects of the paper market pulled their lever. The CME Group, the exchange that houses the world's key silver futures contracts, executed a classic margin call on the entire speculative complex. They abruptly raised the capital required to hold a silver futures contract by more than 50%. This wasn't a response to volatility. It was the cause of volatility. It was a predicate action. This margin hike forced every leveraged player, every undercapitalized speculator, to sell, immediately, at any price. The result was a catastrophic, algorithmic avalanche. In just 2 hours, a staggering 38 million ounces of paper silver, a phantom claim on metal that likely does unexist, were dumped onto the market. This is why the price chart looks like a cliff. This was not a discovery of new value. This was a systemic, forced liquidation of paper promises. It was the sound of the speculative game eating its own participants. And yet, here is where the narrative fractures and the true story begins. While the digital price on brokerage screens was in freefall, plunging to $74.80, a parallel universe held firm. In the physical world, the world of barter, of industry, of tangible assets, the price of a 1 kilogram silver bar did not crash. It held resolute at $142. In markets like Pakistan, the premium to acquire real metal exploded to 55% above the fraudulent spot price. This is the great disconnect. It is the single most important data point in global markets today. It tells you that the paper exchange, with its levers and margins and algorithms, is no longer a price discovery mechanism for silver. It is a price manipulation engine, and it is losing control. The evidence is in the vaults. The COMEX reporting warehouses now show a mere 80 million ounces of silver eligible to deliver against contracts. The number of paper claims on that metal: 570 million. This is a leverage ratio of 7.1 to 1. It is a pyramid scheme built on confidence, and the confidence is shattering. The February delivery cycle already projects demand for 102 million ounces more metal than exists to deliver. This is a mathematical impossibility. The system is broken. The foundation of this physical defiance is not sentiment. It is not speculation. It is arithmetic etched into the infrastructure of our future. Global demand for silver is 1.2 billion ounces per year. Global mine supply is frozen at 810 million ounces. The deficit is nearly 400 million ounces annually, and it is permanent. This metal is not being hoarded in vaults for investment. It is being consumed. It is being laminated into solar panels at a rate of 260 million ounces a year, growing relentlessly. It is being printed into electric vehicle batteries at 75 million ounces a year, a number destined to double. These are not discretionary purchases. A Tesla Gigafactory operates on a 45-day inventory. If the silver stops, the production of every single EV in that factory stops. This demand is absolute, inelastic, and urgent. Simultaneously, the supply taps are being crimped shut. Geopolitical tariffs are permanently diverting over 200 million ounces of annual Mexican production away from the global market. No new major mines are coming online for a decade. The deficit isn't a market statistic. It is a physical fact, a hole in the world's inventory that grows deeper every day. Therefore, the violent plunge in the paper price is not a signal of weakness. It is the final, convulsive purge of speculative excess. It is the system cleansing itself before the underlying physical reality can no longer be denied. Every technical indicator from a relative strength index buried at 19. Two historic lows in the silver-to-gold ratio to the defiant outperformance of mining stocks like Hecla screams that this is a terminal capitulation event, identical to the generational lows seen in 1980-2008. In 2011, the weak paper hands have been eliminated. The path is now clear. Your strategy must now be as binary as the market's condition. You must abandon the paper realm. This means exiting all ETF and futures-based exposure. These are merely bets on the broken system itself. Your capital must migrate to the tangible. Your priority is the direct, unencumbered ownership of physical silver, the form of American Silver Eagles, Canadian Maple Leafs, or 1-ounce rounds held in your own safe or in secure ALLOCATED storage where your name is on the specific metal. This is the only position that will withstand the coming recalibration. For leverage, consider the equities of primary silver miners, who are not just companies, but strategic owners of the scarce resource itself. They are your stake in the price of physical reality, not paper fantasy. The storm has passed. The chaos was a facade. What remains is a landscape of crystalline clarity. The paper market, exposed and over-leveraged, has shot its bolt. The physical market, underpinned by non-negotiable industrial demand and intractable scarcity, stands unwavering. The disconnect between the two has reached a historic extreme. Such extremes do not persist, they resolve. The resolution will be the violent, explosive convergence of the paper price upward to meet the physical truth. The countdown is now visible in the delivery ledgers and the empty shelves of bullion dealers worldwide. The regime has changed. Your task is to ensure your portfolio is positioned on the side of reality, before the last fragile link between digit and atom finally snaps.